Pencils. Good morning, everybody. Welcome to this traditional opening morning session at Davos on the global economy. I'm Michael Elliott, the editor of Time International. This session's done in collaboration with us at Time Magazine, and I've had the great honor of doing this, I think, for 7 years. I look forward to it enormously because I'm always surrounded by people who have fantastic insights and experiences that they can share with us on a snowy opening morning at Davos. Those of you who've been to this session in the past will know that we're notorious for mangling metaphors. We've had the Goldilocks economy, we've had the congealed porridge economy, we've had a positive alphabet soup of recoveries from recession, U's, V's, W's, all sorts of stuff. And we're gathered here today at what I think is a historic moment in the world economy, where what I have christened the 1670 economy, where 16% of the world's population controls 70% of world economic output, may be shifting to a new model. To help us think about what's likely to happen in the year ahead, we have a panel with me up here, of which it really can be said they need no introduction, but I'll quickly run through them. Azim Premji, the chairman of Wipro in India. We're delighted to have with us this morning Nouriel Roubini, professor of economics and international business at the Stern School at NYU. Zhu Min, whose fantastic contributions at these panels in years gone by has now led him to be a special advisor at the IMF. That must be the reason, I think. But Zhu Min...
because of your recommendation.
Zhu Min joins us again. Martin Sorrell from WPP.
On the basis of this, you should be an advertising
market. I'm next to the master. And Jim Turley from E&Y. As we've done in the last few years, I'm going to ask Nouriel to kick us off with a synoptic view of where we are, and then we'll go on from there. Nouriel.
It's a pleasure being here again this year. If I had to characterize the global economy, I have here in front of me a glass is half empty and half full, and I think that's a fair representation of the global economy. There are some positives and there are some upside risks, and there are some negatives and some downside risks, so I would like to cover both of them. I would say that if you want to emphasize the half of the glass that is full and the positive, there is a global economic recovery, both in advanced economies and emerging markets, is stronger in emerging markets. That's a first positive and is ongoing, and the recent data are showing some global economic growth acceleration. The second positive is that the tail risk of outright double-dip recession in advanced economies and the risk of outright deflation are lower than they were last year. And of course, that's a positive, even if the latest data from the United Kingdom, even from the periphery of the Eurozone, suggests that the risk of a double dip or even a long-term stagnation are not gone forever. The third positive is that the balance sheets of the high-grade corporates in the United States and other advanced economies like Europe are strong. They've been slashing costs, especially labor costs, that are flush with profits, with cash. And if they want to do more capex spending and more hiring, they have the money to do so. And their confidence is rising. Therefore, that could be generating greater economic growth. The fourth strength of the global economy is that emerging markets are doing well, both cyclically and structurally. There is still high economic growth in China and India, not just in Asia, but also in Latin America and parts of the Middle East, and even in sub-Saharan Africa. And the fifth positive about the global economy is that last year there was a period of risk on and risk off. Risk was off after the Greek crisis, the Irish crisis, when there were worries about double-dip recession. Right now, risk aversion has been increasing. We're in risk-on mode. There is asset reflation in equity market. Credit spreads have fallen. And that means that there is going to be an improvement in balance sheets through positive wealth effects and through reduction in credit costs. So those are the positives of the global economy. What are the potential negatives and the downside risks for the global economy? First of all, in my view, economic growth in most advanced economies, US, Europe, Japan, is going to be anemic, subpar, below trend, because this painful process of private and public sector deleveraging is still ongoing. It's going to continue for the next few years. The second problem we have in advanced economies is the rise of sovereign risk, large budget deficit, rising stocks of public debt, And within specifically the case of the Eurozone is not just sovereign risk, but also risk of further trouble. You have public debt that are high, but also private debt that are high. We have low competitiveness. We have low economic growth, actually outright contraction still in Spain, in Ireland, in Greece, and barely positive economic growth in Portugal and Italy. So what's happening in the Eurozone is one of the biggest risks to the global economy. The third downside risk to the global economy comes from the recent rise in oil, energy, food, and commodity prices. Has three negative effects. It leads to a rise in inflation, especially in high-growing emerging markets. Is leading to a reduction in disposable income around the world among commodity importers, especially advanced economies. And that's a negative for consumption and economic growth. And now it's leading also to social and political instability. Look what's happened in Tunisia, in Egypt, Morocco, Algeria. This rise in food prices is becoming a serious social and political problem. And this rise in inflation in overheating emerging markets where growth is too high, inflation is rising, there's excessive credit growth, asset bubble is leading to another challenge. Will these emerging markets, starting with China and India, be able to tighten enough and fast enough and have a soft landing of their economy, maintaining high growth and controlling inflation? That's a question mark. It could be a risk for the economies and for the markets. A fourth downside risk to the global economy comes from the U.S. U.S. this year might grow close to potential, but there are four potential downside risks from the U.S. High unemployment rate, since there's not going to be much job creation. 2, the housing market is already double-dipping. 3, there is a significant problems at the level of state and local governments, risk for the muni bond market. And 4, the U.S. is doing very little about this long-term budget deficit. Even what the president proposed last night in the State of the Union is not going to go in the direction of significantly reducing the budget deficit. So there are even downside risks for the United States. 2 final downside risks is that the global current account imbalances are not shrinking. They're not shrinking because commodity prices are rising and there is not enough exchange rate adjustment. And in a world in which 10% is the growth rate of China and 10% is almost the unemployment rate of the United States, in which China is very much slowing down the rate of its own currency appreciation, is a world where these global imbalances, in which this currency tension can lead to currency wars and eventually to trade wars and protectionism. And finally, I would say the glass is half full because for the last 3 years, with a massive amount of monetary liquidity injection in the global economy and with a massive amount of fiscal stimulus. But right now, from the policy point of view, fiscal policy is going in the direction of austerity in advanced economies, in part because the markets are forcing it, bond vigilantes, in part because politics is forcing it. So we're not going to have fiscal stimulus, and there's going to be fiscal austerity. And because of the rise in inflation in both advanced economies and emerging markets, there is not going to be further significant quantitative easing in advanced economies, and emerging markets will have to tighten. So the policy stance is going to go in the direction of more austerity on the fiscal side, less liquidity stimulus, and that could be a negative for the markets and for the economies. So it's a kind of balanced situation in which there are some upside risks, but there are also a number of significant downside risks.
Thank you, Nouriel. Jumin, can you come in? And Nouriel made a couple of points on the performance of the large emerging economies, particularly India and China, the question of inflation there, the need for a soft landing, as Nouriel put it. How do you see things?
Well, as always, I always agree with Nouriel, and he's a professor. And for the emerging market, I think the growth is still very strong, although a little bit of a slowdown, which is very good and healthy. I think in Asia, roughly India and China still lead. China probably will end up with 9 and 9.5% GDP growth rates, albeit still lower than 10.3% last year. India probably will be 8.5 to 8.7, a little lower than 8.9 last year. So still have a very strong overall, if you're looking for all the regions in the emerging market. I think the growth can be very strong because what happened in the last years, we observed the trade pattern happen quite a bit because the intercontinental trade more become intra-trade. The trade become the Asia emerging market within themselves, from themselves to, for example, Latin American, from Middle East, it's really increased dramatically. So I think this is reduce the dependency on advanced economy demand, I think which is a big issue the investments really picked up. We expect to see that further pick up this year, become the main drive force for year 2011, particularly on the infrastructure investment as well. So I think that's a big and a huge business opportunity as well for the world. But obviously, as Nouriel says, there are also a few concerns. I mean, obviously, the first issue is the food price and the energy price. I mean, it's raised way high. I mean, the issue is not only there, because in India, for example, the food composes 47% of CPI. China, 34%. Pork, one item accounts 9% of Chinese CPI. So if you have a food price, volatility, you will have a huge impact on the CPI. The real issue is on the supply side, because the labor cost increase, land cost increase, environmental cost increase. So the supply cost increase. So that's really affect to the second round, we call the general inflation pressures for the emerging market, particularly in the Asia. I think that's a pretty big issue, particularly because the output gap is very much closed in the Asian and emerging market.
So what do you anticipate to be the policy response in India and China to rising prices across the board? Energy, food, labor shortages, what have you?
Well, I think there's two side things. On the monetary side, both countries will further tight monetary policy, tighter liquidities, and further raise interest rates. I think that's important. But also on the supply side, provide more supply on the food side. I think on the food side, you will be able to do that. Obviously, on the commodity side, you need more international competition, which is the reason G20 picked up. I think this is very important. With two-hand side, we probably will be able to maintain the food and the commodity price increase. If we can get that done, I think the general inflation pressure will be released. But in Asia, is also, I mean, the second risk is for the capital flow, because we observed the liquidity is ample last year, and the capital flow is a huge move to emerging market, given emerging market have a much strong growth, less deficits, and the environment is better. Interest rates is much higher, right? I mean, so all this money go. What do we expect to see is a more portfolio capital move into the emerging market, which will be a real shift for global capital relocation. If that's the case, capital is huge. Capital inflow for emerging market, always good news, and the need for the financial sector, for the infrastructure investments. But you've got to be very careful if it's a short-term, very volatile capital flow can cause a negative impact on the financial stability and the macro stability as well.